consumer price index for July, which came out exactly as was expected, which was interpreted by the markets as being good news, because after all, it wasn't worse than what the markets had anticipated. And I mentioned that we were going to be getting the producer price index, which I think is more important because it's a bit forward-looking. And we got that the following day on Thursday. And once again, the number came out broadly in line with expectations. In fact, a little bit better, because the expectation was for a 0.2% rise, and that would have followed the 0.3% decline from the prior month. Now, that prior month was actually revised upward to a decline of just 0.1. So that maybe took a little of the positive out of the lower than expected number for July, which came out at 0. So unchanged for producer prices versus the expectation of a gain of 0.2. Year over year, though, the increase in producer prices was 4.7%. That was better than was estimated at 4.9, and a lot better than the prior month, where it was 5.5. But again, all of this is the transitory effect of energy prices. I went over that on the podcast I did on Wednesday. It has to do with the fact that they measure average prices for the month, not month-end prices, because if they looked at where prices ended the month, there would have been a huge move up in July. But because they used the average, the fact that it had a big decline in the prior month and then gradually rose in the current month, that's what kept the numbers lower than they normally would have been. Now, ex-food and energy, the so-called core, there was an increase because it was the energy market that was pulling everything down, and the increase was 0.2. Again, a little bit better than the 0.3 that had been estimated, but exactly the same number that we got, 0.2, in the prior month. And year over year, the core, excluding food and energy, producer prices up 4.2%. Now, again, if the Fed is targeting a 2% inflation and you've got producer prices rising year over year by 4.2, you are nowhere near your 2% target. And as I mentioned, this is forward-looking, because before consumers pay higher prices, the producers have to pay higher prices because they pass them on. So if you're seeing producer prices hotter than consumer prices, that's giving you a pretty good look at what's going to be happening to consumer prices in the future. But again, what's a lot more important to me is monetary policy and fiscal policy, because that is the driver. And in fact, later in the day, we got the Fed's balance sheet numbers, and the balance sheet expanded by $11.39 billion on the week. And that followed a $10 billion expansion in the prior week. So the Fed is doing quantitative easing. The Fed is expanding its balance sheet. That is what is inflationary. And in fact, again, looking at the national debt, continues to move up. We're almost now at $39.92 trillion. So, we've got just a little over 80 billion left to hit a $40 trillion national debt. We could easily do that in this coming week. If we don't do it this week, it's going to be next week. But it is the soaring debt and the expanding money supply that has to be what investors and what consumers are looking for as an indication of where future inflation is headed. Now, not only did we get inflation news, but we got some more economic news that also points not just to inflation, but stagflation. Retail sales, this is for July. They were expecting an increase of 0.1. Instead, retail sales plunged by 0.6. This was the biggest decline in over a year. The range of estimates was minus 0.3 to 0.5. And we came out double the low end of the estimates at minus 0.6. And again, these numbers are not adjusted for inflation. And that means that in real terms, consumer sales fell even more, or retail sales. What's happening is that prices are going up. And so consumers have to pay more for what they buy. They end up buying less because they can't afford to buy as much because the prices are higher. But retail sales doesn't measure how much you buy. It measures what you pay for the things that you buy. And the only reason that the number isn't even worse is because of inflation, because what consumers are still able to buy costs more money. So this is a negative. In fact, even if you exclude vehicles, sales were down 0.3 versus an expectation of a rise of 0.2. And if you strip out gasoline and vehicles, it was another decline, minus 0.2 versus expectations for a rise of 0.4. So way below estimates when you take out cars and gasoline. Also, consumer sentiment plunged in August from a month ago. Prior month, it was at 55.2. They were expecting 54.2, so a little bit of a decline. Instead, consumer sentiment tanked all the way down to 51. The range of estimates was from 52.5 to 57, so way below. And the reason was rising inflation expectations. For a year ahead inflation, consumers are looking for 4.3% price increases. Prior month, it was 4.2. Now, of course, it could end up being a lot more than 4.3. In fact, I think consumer sentiment would be a lot lower if consumers actually realize just how bad inflation is going to be. And of course, you have the Federal Reserve. They still maintain that consumer inflation expectations are well anchored at 2%. Well, how are they anchored at 2% when consumers are expecting better than 4% inflation? And not even the markets, I think, buy into this 2% nonsense. In fact, one of the most disturbing developments, I think, in the market on the week was the way the bond market reacted first to what was perceived as better than expected inflation news. And again, what really makes it better than expected is that it wasn't worse, because people brace for a negative surprise, a hotter number. And so there's a sigh of relief in the markets when we don't get a hotter number. But when you couple the supposedly good inflation news, which isn't really good, but let's say it could have been worse, when you compare that with the weak economic data, especially retail sales and consumer sentiment, normally you would see a rally in the bond market. The bond market likes bad news because it means the Fed is less likely to hike rates if the economy is weaker. But instead of bonds rising, bonds fell. In fact, this was the lowest weekly close, really, of the year in the bond market, and the highest yield for bonds. The yield on the 10-year Treasury closed the week at 4.7%. And the 30-year closed at 5.27%. This is the highest that's closed the week. And in fact, if you look at TLT, which is the closed-end fund that has an average maturity of 20 years, because it owns, I guess, 50% 10-year, 50% 30-year, or however it does it, it maintains an average of 20-year maturity. That closed at a new low for the year, down about 0.5% on the week. It's now off just under 6% so far this year. And from its peak in 2020, that ETF is down by 50%. This is a major, major bear market